Yes guys, so now we have solved the workbook. There are certain additions in the study material which occurred in 2021. There were two specific problems which were included into IND AS 16 subsequently. Those two problems is what we are concentrating on. So please make sure that you turn to your module 4. In your module 4, in your additions, we have two questions which are specifically related to your property, plant and equipment. Let's try to solve those two. The first question being very interesting. It's a very, very interesting question that we'll come across. Let's turn to that question. This is my question. Read the question. H Limited purchased a property, plant and equipment costing 100 million, which had a useful life of 10 years. The entity had a contractual decommissioning and site restoration obligation, which is estimated at 5 million, expected to be incurred at the end of 10th year. Guys, 10 years itself is irritating, man, because 10 years of discounting is what you have to apply. The current discount rate is 8%. The company follows an SLM method of depreciation. H Limited follows a cost model of accounting the property, plant and equipment. Determine the carrying value of property, plant and equipment and also the decommissioning liability at the end of each year, when there is no change in the expected decommissioning expenses and the estimated timing of incurring the decommissioning expenses or the discount rate. So there is no change. Then what is the accounting treatment? At the end of year 4, second criteria, if the entity expects that the estimated cash flows on account of decommissioning and site restoration is incurred at the end of the useful life will be 8 million in place of 5 million as is estimated in the process. Determine in case B, H Limited need to account for the changes in the decommissioning liability. Comprehensive question, has a significant amount of materials involved and a lot of calculations also involved. I'll take the first part. There is no change in the decommissioning expenses, no change in the timing of this expense and no change in the discount rate. My intention to identify what will be the carrying value of the property, plant and equipment, what is the amount of decommissioning liability which will be recognized every year. Let's see. Question number 69 for your additions. So let's start solving this. First, what is the original cost of the asset? My original cost asset. Let me write all rupees and millions, guys. Will become too difficult if I write it in rupees, because there are 10 years of calculation. It will be easier for me to round off as well. 100 million is the original cost of this. Present value of decommissioning liability. What is the decommissioning liability as far as your question is concerned? Just check. 100 million is the cost. The decommissioning liability is 5 million, expected to be incurred at the end of year 10 when discounted at 8% rate of interest. So let's start finding out the amount. 5 million into present value factors, 8% discounting for 10 years. Find out. 1 divided by 1.08, 8% discounting, 10 years, 1, 2, 5, 6, 10. It is 0.4632. 0.4632 is your answer. So 0.4632 into 5. 2.316 is your answer. 2.316. Cost of PPE capitalized, including the value of decommissioning liability, is 102.316. Remember guys, this has to be depreciated over 10 years, no estimated residual value. Nothing given in the question. Assume estimated residual value as 0. Okay. I need to find out what is the written down value of the asset and the amount of decommissioning liability every year. Let's look at this. Here, okay. WDV at beginning of year, the amount of depreciation becomes too big. Let us try to crunch it down into the same statement. You don't write it first, so look at it, then you can actually take it down. Depreciation per annum, WDV at end of the year. Look at how many columns that we get here. Okay. Opening decommissioning liability. I'm writing it as decom just to fit it here. Interest cost during the year. And finally, closing decommissioning liability. Let's start. Year 1. At the beginning of the year, the value of the asset is 102.316. Let us cut it short. Let's make it 32. Okay. Depreciation is 10.23. I'm rounding off even further. Okay, so the WDV at the end of the year 102.32 minus 10.23. I'm rounding it off only to 2 decimals, guys. 92.09. Okay, like this you keep continuing. I'm doing a straight line method. 92.09. Straight line method. 10.23 depreciation. $81.86. Year 3, 81.86 is opening minus 10.23 71.63. Second, continue. Year 4, 71.63. Depreciation continues to be 10.23. Calculate. How much is the answer? 61.4. Continue. Year 5, 61.4 minus 10.23. 51.17. Continue. Year 6, 51.17 minus 10.23 is asking me to calculate every year, so I'll have to do this. If you're doing it much faster than me, you can go for calculation of your cost of dismantling as well. 740.94 minus 10.23 is 30.71. Here 8, 30.71 minus 10.23 is 20.48. Here 9, 20.48 minus 10.23 is 10.25. Here 10, 10.25 approximation. Instead of 10.23, take the depreciation last year as 10.25. So that last year the carrying value becomes 0. That is because of the approximation that you have done. So many approximations you did well. Your decommissioning liability, again I'm rounding it off to 2 decimals only. So I'll start with 2.32. Interest should be calculated at 8%. Okay. 2.32 into 0.08, 0.19. So I'm rounding it off. It is 1856. I'm rounding it off. So my closing liability will be 2.51. Okay. My 2.51 into 8% is 20.51, 0.2. So this will be 2.71. 2.71 into 8%, 0.22. Keep adding your decommissioning liability, guys. Keep adding. Amount will be 2.93. 2.93 into 8%, 0.23. This will be 3.16. 3.16 into 8%, 0.25. This will be 3.41. 3.41 into 8% is 0.27. This will be 3.68. 3.68 into 8% is 0.30. Actually 29, I'm sorry. 29. Add it up. This will be 3.97. 3.97 into 8%. .32. So this will be 4.29. 4.29 into 8%. .34. This will be 4.63. 4.63, guys, closing should become 5. So this should be 0.37. This you don't have to calculate. Take it as a balancing figure. It is more appropriate if you take it as a balancing figure itself. Clear? Now, this will answer the first part of the question. What was the first part of the question which he asked? Find out or determine the carrying value of the asset and the decommissioning liability at the end of each year. When there is no change in the decommissioning expense, the estimated timing of incurring the decommissioning expense and the discount rate. Now look at what is the change. At the end of year 4, second part I'm talking about, if at the end of year 4, the entity expects that the estimated cash flows on account of decommissioning and the site restoration at the end of the useful life is 10 years, is 8 million and not 5 million, then how will your answer change? Guys, if it is 8 million and you are estimating that at the end of year 4, this 8 million is expected to be incurred at the end of 10 years. So how many more years to run from the end of year 4 to the end of year 6? 6 years. So discount it by 6 years and calculate. This I am talking about is part B, where I am saying the change in decommissioning liability to rupee 8 million will be considered as 8 million from there on. Now, in such case, what do you do? If the decommissioning liability is considered to be 8 million, then how will I record this transaction or record the change in the transaction? In such case, I'll have to record the entry like this. First, present value of decommissioning liability I am expecting to incur 8 million and I will expect that this amount will be incurred at the end of 6 years because I am estimating this at the end of 4th year. So 8% same discount rate. If I take it, calculate 1 divided by 1.08. How many years? 1 divided by 1.808. 6 years. 1, 2, 4, 5. It is 0.6302. 0.6302 or 0.63 into 8. This amount of liability now will be considered as 5.04 at the end of year 4. Now at the end of year 4, what was your decommissioning liability actually? Go back up above and check. At the end of year 4, my decommissioning liability and my carrying value of the asset went like this. So this is my decommissioning liability. This is my carrying value of the asset. So 3.16 has now become 5.04. Carrying value of decommissioning liability is 3.16. Therefore, what is the amount of increase? Increase in decommissioning liability at the end of year 4 is how much? Calculate. 5.04 minus 3.16, already carrying value. Answer is 1.88. So at the end of year 4, I will pass an accounting entry. What accounting entry you will pass? I will increase the value of property, plant and equipment, PPE account debit, to liability for dismantling or decommissioning. Your decommissioning liability has increased along with the value of your asset. How much is the amount of increase? 1.88. Now, in this case, up to year 4, the computation will be the same. You don't have to calculate what is the written down value of the asset each year again, because the change has only occurred starting from year 5 up to year 10. Same is the case even with liability for decommissioning as well. Let's see. Again, let's start. Here, I'll start only from year 5. Opening WDV, depreciation, closing WDV. Same way, opening decom liability, decommissioning liability, interest at the rate of 8% every year. That was the discount factor you applied. What is my closing decommissioning liability? Calculate. Now you use your calculator, get into mode and calculate. Here, I will start only from year 5. My opening WDV right now has undergone a change. Why? Because you have added 1.88. What was the closing WDV at the end of year 4? 61.4. 61.4, you added 1.88. So calculate what is the opening WDV. 61.4 plus 1.88. Amount of liability or opening WDV is 63.28. This 63.28 now should be depreciated over the remaining 6 years. So divided by 6 to get this depreciation. This is 63.28 divided by 6. Further 6 years to run. Depreciation is 10.55. So what is the closing WDV at the end of first year? 63.28 minus 10.55. 52.73. Year 6, 52.73 minus 10.55 will give you 42.18. Year 7, 42.18 minus 10.55 amount of depreciation should give you an answer of 31.3. Next, year 8, 31.63 minus 10.55 depreciation every year would give me an answer of 21.08. 21.08 and depreciation of 10.55 every year should give me an answer of 10.63. Year 10, 10.63, depreciation is 10.63, close it there. This is the balancing figure. Closing WDV will become 0 at the end of 10th year. My decommissioning liability today, I have re-estimated the value at 5.04. At the end of year 4, my opening decommissioning liability is 5.14. Correct? 5.14? 5.04. I'm sorry. It is 5.04. Calculate 8% on this. Rounding it off 0.4. This becomes 5.44. 5.44 into 8%. 0.44 again. 5.88. 5.88. 8%. 0.47, which is nothing but 6.35. Continuing, 6.35 into 8%, 0.51, 6.86. 6.86 into 8%, 0.55 is 7.8. 7.41. 7.41, remember, it has to become 8 million at the end. So therefore, last year decommissioning liability interest is a balancing figure, should be 0.59. So this is how I calculate whenever there is a change in the decommissioning liability. Guys, remember, I'll add a point. I'll add 1 point. If there is a change in the value of decommissioning liability, you adjusted it to the cost of the asset. You adjusted it to the cost of the asset if there is a change in the value of decommissioning liability. But if there is a change in the interest rate, then I will not adjust it to the cost of the asset. If there is a change in the interest rate and not the value of decommissioning liability, to the extent of the change in interest rate, I will adjust it to P&L. It should not be adjusted to the cost of the asset. I'll make sure that you people write this sentence as well. Very, very important point. A change in estimated cost of dismantling should be adjusted to the value of property, plant and equipment on the date of such change. However, I'm writing a statement now. However, if there is a change in decommissioning liability or dismantling liability, arising due to change in discount rate. If the change is due to a change in discount rate, then it should not be adjusted to the cost of the asset, not be adjusted to cost of asset, and instead it should be charged to P&L, and instead it should be charged to P&L. A change in the estimated cost of dismantling should be adjusted to the value of PPE on the date of such change. If there is a change in estimated cost of dismantling, but if there is a change in the liability due to discount rates change, then it should not be adjusted to the cost of the asset, but it should be charged to the P&L. Remember this concept very, very clearly. I will bring about a question which will be tested on these two logics. Now you will say, you completed workbook problems, you completed addition to study material. Where will you bring this change? I will bring this change when I look at compendium of solved illustrations, where plenty of questions have come up, and this one has been tested as a part of your RTP. This has been tested as a part of your RTP. So please make sure that this particular change, you people are aware of what I'm talking about. Clear? That word is adjusted, where I think I covered it. Now let's look at the next question. Answer is absolutely right, guys. There's no doubt about it. Okay, question number 70. Mr. X, an individual who's a financial controller of ABC Limited, a listed entity, which prepares consolidated financial statements in accordance with IND AS. X recently produced the final draft of financial statements of ABC for the year ended 31st March 2018 to the Managing Director Y for approval. Y is not an accountant and raised the following query from X after going through the draft of the financial statements. The notes of financial statements state that the plant and equipment is held under the cost model. However, the property which is owner occupied is revalued annually to fair value. Change in fair value are sometimes reported in P&L, but usually in other comprehensive income. Also, the amount of depreciation charged on plant and equipment is a percentage of carrying amount is much higher than for owner occupied property. Another note states that the property owned by ABC Limited but rented to others is depreciated annually and not fair value. Mr. Y is of an opinion there is no consistent accounting treatment of PPE in the accounts. How should the financial controller respond to the query from the managing director? The problem is the people who have half knowledge have such kind of queries which will come up. So this man who is not an accountant very clearly is saying there is no financial knowledge, so he is asking multiple queries. So let us try to answer each one of them. So look at the first one. The first one, he is saying that the notes of financial statements state that the plant and equipment is held under cost model. However, the property which owner occupied is revalued annually to its fair value. Is it fine? Is there a lack of consistency? Absolutely no. Because plant and equipment and owner occupied properties are two different classes of assets. The nature of asset is different. The purpose for which it has been used is different. So therefore, you can have these two classes following different subsequent measurement, where property, plant and equipment, or property, plant and equipment can follow cost approach and the owner occupied properties can follow fair value approach. It is absolutely consistent with the requirements of IND AS 16. There is no problem regarding this because they are different classes of assets. Assets within the same class should follow the same method of subsequent measurement, but two different classes of assets can adopt different measurements for subsequent measurement. Now, that is the first one. Change in fair value is sometimes reported in P&L, but usually in OCI. What do you transfer through OCI? It is nothing but your revaluation surplus. So he is saying sometimes when the fair value changes, sometimes he is reporting in P&L, sometimes he is reporting in your revaluation surplus. Yes, if there is a downward revaluation, it should be reported in P&L. If there is an upward revaluation, it has to be transferred to revaluation surplus. If it was downward revalued initially, subsequently upward revalued, to the extent whatever you charged to P&L earlier, you have to credit the P&L now. So these are sometimes happening in such a way that sometimes you charge it to P&L, sometimes you transfer it through OCI to revaluation surplus. They are absolutely correct. There is no inconsistency in this treatment at all. Also, the amount of depreciation charged on plant and machinery, on plant and equipment as a percentage is higher than the owner occupied property. Where the depreciation charge depends on the useful life, the cost and their residual value. So if their residual value and useful life are different, then obviously even your depreciation charge is different. In sense, plant and equipment generally has a lower useful life than the property on which owner is actually occupying, because buildings tend to have much longer life than plant and equipment. Therefore, it is absolutely fine even if the percentage of depreciation is not same. Remember, the depreciation charge to P&L should represent the pattern in which economic benefits are expected to be consumed by the enterprise from the use of the asset. So as long as we are meeting IND AS 16 and Companies Act Schedule 2, then absolutely fine, the depreciation rate need not be common for plant and equipment and owner occupied property. Another note states that property owned by ABC but rented out is depreciated annually and not fair valued. Guys, here I am using IND AS 40. I know we haven't read IND AS 40, but please remember, whenever there is a property owned by an enterprise but let out, but if it is let out under operating lease, it should be considered as an investment property. Investment property under IND AS 40 should only be reported as per cost approach. Subsequently, fair valuation of investment property is not possible. It is not allowed as per IND AS 40. Therefore, the treatment which is given for such kind of assets which are owned by the company but actually let out should be classified under IND AS 40. Subsequent measurement should only be as per cost model. So since he is not doing any fair valuation, his treatment is absolutely right. That is your response to the financial controller, to the managing director. That's it. That will bring us to the end of questions on IND AS 16. I haven't written the answer for this because it's a theory based question. I think you people can find out the answer there itself. So you can either read the answer, or if you want, you can write the answer for yourself, quoting each paragraph. Give your answer in support of the financial controller to be replied to the managing director. Clear? So that will bring us to the end of discussion on IND AS 16. The illustrations which are related to the standard for better understanding of the standard, and the workbook questions which we have solved even under module 3 as well as module 4, which is a new additions in your study material. To finish off, we'll have to look at the compendium of solved illustrations, which you can solve it, where there are answers also provided, but I'll make sure that I make an effort to discuss these solutions as well. Clear?